morning and welcome to Reuters Today. I'm Marion Bamard. The much anticipated results for heavyweight BP disappointed investors today. The oil giant reported lower than expected profit for Q2 off the back of weak refining margins and oil prices. BP has cut its 2016 investment budget to below $17 billion. Investors were hoping BP could turn a corner after 6 years of cuts following the 2010 Macondo well blowout that killed 11 workers and, of course, spilled millions of barrels of crude into the Gulf of Mexico. This month, BP said it expects the total cost of the disaster to be about $62 billion, including cleanup and government fines. That, coupled with lower oil prices, means the oil major won't likely turn profits in the short term, especially, of course, since Shell and ExxonMobil have both taken its market share. Despite the oversupplied glut in the market, the expectation is that oil prices will stabilize, and that could help BP return to growth. We spoke with Daniel Morris, senior investment strategist at BNP Paribas, on the short-term outlook.
The range that you had over a fairly long period of time was roughly $30 to $40. And I think that's more of a relevant range for oil prices than the $100 per barrel that we had when China was growing so much more strongly. Starting to bring the supply and demand imbalance in line, but still probably excess supply. And of course, anytime oil does tend to spike up, you get the potential for increased supply again from the U.S. So on balance, all factors, I think, arguing still for a modest depreciation or fall in oil prices, but not a collapse towards levels in the 20s like we had earlier in the year.
With earnings season now underway, let's take a look at what other stocks are on the radar today. Man Group under pressure this morning after posting a 3% fall in first-half funds under management. The world's biggest listed hedge fund manager saw weaker investment with net inflow that is, at only about $1 billion for the first 6 months of this year, compared with outflows of almost $3 billion. Different story, though, for British engineering company GKN, which maintained its outlook for 2016 to be another year of growth. That's off the back of £30 million in cost-cutting to help boost next year's results. The manufacturer of auto and plane parts expects little impact over the medium term from Britain's vote to leave the European Union, reporting a 7% rise in Q1 earnings. And we'll get a better sense of how much appetite investors have for luxury goods these days when fashion house LVMH releases its earnings this afternoon after market close. The owner of Louis Vuitton is expected to report new growth strategies for its European market. Let's turn now to the markets to see how we stand in early trade. Most major indices in the red this morning. The FTSE 100 lower off the back of investors that is digesting corporate earnings and weaker commodities, while the FTSE First 300 down almost 0.5% after weaker bank results. Investors will also be looking at the health of the UK economy post-Brexit vote, with the latest figures from the UK June mortgage approvals out shortly. It's not a toast just yet to Anheuser-Busch InBev, the world's biggest brewer, raising its takeover offer for SABMiller. But the expectation is that the $104 billion takeover offer for SABMiller, headquartered in London, could seal the deal. It's been a bumpy road for the two brewers, with the pound sterling losing ground following Britain's vote to leave the EU. AB InBev will now offer £45 a share, a rise from the £44 announced in November last year. And that puts the value of SABMiller at about £79 billion or $104 billion US. That's it for now. Don't forget, you can follow us on Twitter at Reuters Insider and, of course, watch more videos online at Reuters.com. I'm Marion Bamard, and this is Reuters.